All right, so good morning, guys, and you are welcome to the part 2 of our cost of capital study on WACC. We've already done the cost of equity capital, and today we are looking at the cost of debt. All right, so you look at it from this front. These are the cost of debts that we're going to look at. Now, the debts we have includes redeemable debt. It also includes irredeemable debt. The redeemable debt can be at a discount, redeemed at a discount or at a premium. We have irredeemable debts, all right, those ones that are not even redeemed at all. Then we have convertible debt, which has equity component of it and a liability component of it. And here we are going to see how conversions will be done. We also have the short-term tradable debt. So we are looking at basically 1, 2, 3, 4. Then we add preference shares as part of our debt. It actually has two sides to it. We have redeemable preference share, which is a debt according to IAS 32, and we have irredeemable preference share, which is equity according to IAS 32. All right, so that is from the financial reporting perspective of things, all right? And I use this diagram to explain to the fact that every entity has an asset, and their assets are categorized into their NCA. In financial management, that is your capital expenditure. All right, when we're doing investment appraisal, you saw the capital expenditure. Then we also have current assets. Here we regard them as part of your working capital, which is funded by equity and liability. So we dealt with the cost of equity funding. We are now also look at cost of liability funding. All right, so basically that is that. And so the cost of debt, we are starting with the cost of debt, KDI, cost of irredeemable debt. And so cost of irredeemable debt is such that you have the interest, and the interest 1 minus T divided by market value of the debt, X interest. The interest here is a cash flow interest. Bear in mind, it's not the effective interest. No, it is the coupon interest. All right. So we are looking at the nominal or the cash flow interest, the money that you could be paying. All right. It is that money that tax is on, not the effective interest you used to do your finance cost thing. No. So this one is the coupon one. All right. So that is that. And you do X tax on it. All right. So 1 minus T. All right. And I always say that the coupon value for the interest in financial management is 100 cedis unless otherwise stated. All right, it's 100 cedis because we are looking at par unless otherwise stated. All right, so that is that. So you do that, you have your coupon. All right, you have your coupon. Then 1 minus T. So that is the irredeemable coupon concept. All right, so that is that. And we have an example here that I want you to look at. So this one is the Lepus example, who has a loan note of 100 cedis nominal. So that is the coupon. All right, the nominal. So always use that. And the nominal value with an annual interest of 9%. So that is our interest. All right. So that is that. Then it's done per year. So it means the interest is a full year interest. The market price is 90. All right. So we will do 9% on 100 to find the interest, which is 9 cedis. All right. Then we will now divide it by the market price, X, the market value of that X interest. All right. Take note of that. Now, you understand cum Dave X Dave. So it's the same here. So if interest is about to be paid, that means cum. So you will deduct it and get your X. All right. So that is, then you have 10%. All right. Then we also have this illustration from illustration 5. Like I've said, try and get the book. It helps a lot. All right. So wherever you are in Ghana, you can place the order to this number and you'll be fine. Now, we have 12% irredeemable loan. All right. And the nominal 100, of course. The market price is 95x interest. Calculate the cost of capital if interest is paid half yearly. So you've seen that they've changed the dynamism a little bit. But if you remember, you used to do this. Raised to the power n, right? Yeah, because this time round, the interest is being divided by number of the payments, the periodic payments, all right? So if you have this, then of course, you are dividing this side by your market, because that's the interest. You are dividing it by your market value x interest, all right? So basically, that is what we do. All minus 1. If this is on the formula of time value of money, the top there, if you remember. So if that is the case, then it means that we have 1 plus 12 divided by 2, all right, all over 95 raised to the power 2 minus 1. All right, that is when the payment is done. All right, so if it is done on quarterly basis, here will be 4, here will be 4. All right, basically that is that. So if we go ahead to do this, then what are we having? We have like 12 divided by 2, that's 6, and 6 by 95. Learn how to do situations where there is a plus. This is not, you can't combine the top, it's a plus. The plus is long plus. So you can't combine the top first. So the 1 is for all. So you do 6 over 95. Whatever answer you do plus 1 raised to the power 2. That gives me 1.130304 and all that. All minus 1. I have 0.13, 2 decimal place, and that is 13%. So that is what you do. All right. So basically, that is that. All right. So this is how you find cost of irredeemable debt. All right. It's as simple as that. All right. Then we go to cost of redeemable. Now, the cost of redeemable is given by IRR. So that is that. Cost of redeemable is given by IRR. So cost of debt redeemable. So that is the second one we are looking at. So redeemable, cost of redeemable debt is given by RRR. So if you remember how we used to do IRR, it's simple, all right? So that is that. Okay, but this is what you need to do in terms of doing your IRR. You set up your year, set up the cash flow, all right? That is that. You will need a discount factor. Then you get your PV, all right, for the first one. Then you come with it in another discount factor. Then you do another PV. All right, so that is that. So here we apply annuity because the interest is the same yearly. All right, so your year 0 and 1 to whatever number of years, let's say n years, then you have your redemption. This is the interest. So what you're going to do is that the cash, the year 0 is your market value of the loan interest, the debt, market value. All right, don't forget X interest. This side, the middle, is the interest 1 minus T. So interest 1 minus T. Then here is the redemption value, which can be at a discount or at a premium. So take note of that. Take note of that. Then you get your discount factor. My advice to you is that the discount factor, use the very first one of the irredeemable. So if it is 6% irredeemable, here will be 6% sort of. Then you do your PVs. Then you know how to do your IRR. You change the discount rate, you get another PV. Then your IRR formula comes to play. IRR is the rate at which the NPV is equal to 0. So if you get 0 here, then it means your IRR is this rate. All right, but if you don't, then you are going to use the interpolated formula. All right, so which is given by A plus NPV of A divided by NPV of A minus NPV of B into bracket B minus A. All right, and your answer should always be in percentages. So you can decide to do percentage here, do percentage here, whichever way you want to do it. All right, so that is that. Okay, so that is how you are going to set up your IRR and figure out the figures. So I'm just going to show you the issue here, so you will see that. Now, you have this particular illustration. We are going to use that and As you can see, the solution is beneath. So I'm not really going to demonstrate it in the workings as you see it here because the solution is there. All right. But what I can say is that if you are having a redeemable debt of which the market value here is equal to the redemption value, you don't need to use this IRR formula. So in a situation where the market value is equal to the redemption value, you can go back and use the irredeemable formula. Clear? So that is that. So KD, so this one gives you your KD redeemable. All right. But KD redeemable if market value is equal to redemption value. So let's say your market value is 100, redemption is 100. Then you can use I 1 minus T over MV. That's what I'm saying. That is only when the market value is equal to the redemption value. Take note of that. I'm not saying you do that all the time. You apply this one only when the market value is equal to the redemption value. All right. So that is that. Other than that, you have to use your IRR. So IRR will give us the answer. So if you look at this one, for example, you look at this work that is here, for example, you will realize that we have, so this gives you the format, and this is the question. Owen Alot has an issue 10% loan note with a nominal of 100, market value is 90x interest. And you are doing this if it is irredeemable. Now, if it is irredeemable, what do you do? 10% over 10% multiplied by 100 cedis, that gives you 10. X interest is 90, so it will just be 10 over 90. All right, so that is that. Then redeemable at par after 10 years. So if it is redeemable at par after 10 years, then that is what. So as for the irredeemable, it's simple. So 10 over 90 you go. But the redeemable, we say you use the IRR. We needed market value. Is that not it? We needed market value. So in this case, if I'm to use this template, you realize that market value is what? 90, right? And that is your outflow. Don't forget that. All right. That is kind of your capex. So it's into bracket. So that is what you do. So as you can see, then you are paying the interest for 10 years. So interest 1 minus T. Here we say the question said we should ignore taxation. So there is no tax. All right. Then the redemption, it is redeemed at principal. The same is 100. So you do this, you read the annuity factor for the, I said that you can, the rate depends on you, all right? So you can do that. You can do any rate, but I would advise, so I'm going to do this with a different rate. So let's say I have my year, so year 0, then 1 to 10 years, then on the 10th year, I will pay my redemption. I need the cash flows. So the year 0 is the market value, which is 90. Interest is the coupon interest. So 10% of 100 is 10. Don't forget that. It's 10% of 100. It's 10. So that is that. On the redemption, we are not told how much the redemption is. Of course, I told you that if it is not mentioned, everything is at par. So 100 cedis. Now I'm going to use the discount factor. The first discount factor I'm going to use is the 10. All right, instead of the 12. So 10%. So let's read 10%. This is 1.00. What is 10% discount factor? So the page we are referring to here for our work is page 388. What is 10% for 10 years? So we just go and read 10% for 10 years annuity. So this is our annuity table. Of course, we know it is an annuity because of the formula, not because it is here. Because in your exam, this sheet will be given to you, but they won't write the annuity there. It is the formula that you will see. All right, so we look at 10% for 10 years. That is 6.145. So 6.145. 6.145. And on the 10th year, what is the discount factor for 10th year? So I'll come to 10% discount factor for 10 years is 0.386. That's what it reads. 386. All right. So then I'll get my PVs. Okay, so let's go on. Of course, this one will be always 90. Then we have 6.145 by 10. All right, that is 61.45. Then we have 100 multiplying by 0.386. That gives me 38.6. So what is my total PV? I added 61.45 minus 90. My PV is a positive 10.05. All right, so I'll go again using a new discount factor. Of course, this is positive, so I need to move forward. So let's say I'm using a discount factor of 15. It's a choice. Nobody tells you which one to use. It's a choice. If I'm using a discount factor of 15, here will still be 0. My PV will be negative 90. Discount factor of 15. So 15 for 10 years. 15 for 10 years is 0.247. 0 is what? No, this is a discount factor. We need annuity. So 15%, 10 years is 5.019. 5.019. So I'll multiply my 10 here on this one now. So 5.019 multiplied by 10, that should give me 50.19. So correct, 50.19. Then the same 15%. So here was 15%. I'm reading it now, discount factor, 15% for 10th year, 0.270. So 0.270 multiplied by my 100 is 27. So what do I have? I have the 27 plus 50.19 minus 90. Minus 90. And that gives me negative 12.81, which means I went very far with the discount. I should be getting somewhere close to 0. All right. So I will use my IRR. So KDR will now be given by IRR. So A, which is 10%. So I will say 0.1. All right, plus MPV of A, which is 10.5. That's the 10.05. That's the MPV of using A. So 10.05. So I have 10.05 minus 12.81. All right, into bracket 0.15 minus 0.1. So 10. So that is it. So it makes this side a plus, right? Minus, it's a plus. So what I'm going to do is to add that part to 10.05. All right, that's like 22.86. So 10.05 divided by that gives me 0.439, blah, 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 plus 0.1 here. That is that. Multiplying into brackets, I have 0.15 minus 0.1, multiplying the answer that I had before. And that is giving me 0.026. So 0.269. So in 2 decimal places, this one is like 0.03 and that is like 3%. All right, so that is my cost of debt. So that is how you do it. You use the IRR to achieve that. So let's go back to our page 888. So here 12% was used and 11%. So the cost was 11 points. So you see, everybody can get a different answer. That's the beauty of financial management. All right. So the process is the one that is marked. And I told you that if the value redeemed is at the same as the current market value, you use this formula instead. So that's how you do cost of debt. All right, redeemable. Now we go to the next form of convertibles. So you are looking at the next form of debt, the cost of debt convertibles. So 3, you are looking at convertibles. Now, convertibles are the ones that has equity inside and also liability inside. Here, the first thing you need to do is to find out, you realize that sometimes you convert the liabilities into shares. All right. So the first thing you need to do is to find whether the shareholder or the liability holder will convert it or not. Now, if you are going to convert, if you realize what we learned in financial reporting, IAS 33, we learned that they are going to convert if the number of shares that they will get is more. All right. So basically, that is that. They will convert. All right. Because if the share price is paying more than the debt, everybody will convert. So the first thing we need to do is to determine conversion. So in convertibles, that's the first thing, determine conversion. And how do you determine conversion? Determining conversion is given by a formula, all right? It's given by a formula. And the formula is PO into bracket 1 plus G, that is growth, raised to the power N, then R. I'm going to explain this thing to you. Now, what is PO? So PO is the market value of the shares at conversion. At conversion. All right. So they will tell you that debt without conversion will have this price. All right. Without conversion will have this price. Without conversion will have that price. So that is the price. All right. 1 is 1. G is growth. Is growth. What is N? N is the number of time or the number of years to conversion. To conversion. Then what is R? R is the potential shares they will get. All right. The conversion rate exchange. So that is that. Conversion shares. So that is the first thing you do. So better place, this is it. The number of shares, the number of years for conversion, expected growth on the ordinary share price, then the price, current ex-date ordinary share price. All right. So that's the market price of conversion. All right. So basically that is that. Now, then when you are able to do that, you will get the value. All right. So the conversion value. So CV is the way we, so when you get your CV conversion value, you will now compare. So step 2 is to compare the CV conversion value to the redemption value. And don't forget, redemption value can be at a discount or at what? A premium. And like I said, this is redeemable because it is only redeemable that is redeemed for you to have a redemption value. So you compare conversion value to redemption value. Then, when you are done, you are going to select the highest one to be your redemption value. So if your CV is bigger than your redemption value, then it means your redemption value will be your CV. If your redemption value is greater than your CV, which is the conversion value, then your redemption value is your redemption value or the conversion. If the redemption value is bigger than the conversion value, then your redemption value will be your redemption value. Step 3, of course, you are looking for KD convertibles, and so the formula is still IRR. It's just that the value down at the last day, which is the redemption value, can either be the CV or the redemption value, whichever is what? Higher. Basically, that is that. All right, so that is it. So now, because if you don't convert, you collect cash. But if you convert, you get the value of a share. All right, so that is that. So let's look at, and I've highlighted the steps here too in your manual. So look at this particular example. A company, and so this is it. A company has 8% convertible loan, which are due to be redeemed in 5 years' time. They are currently quoted at 82 per 100 nominal. I've told you it's always 100, all right, unless the question makes it 1,000 or something. The loan notes can be converted into 25 shares in 5 years' time. The share price is currently 3.5, and it is expected to grow at 3% rate. Assume tax to be what? 30%. So the current share price, which is the share price at the date you are making the arrangement, the PO. So at the date, let me see, at the date of arrangement of conversion. So current share price, the date you are doing the agreement, all right, that share price. In IFRS, we call it a fair value at grant date, all right. So that is that. So this is it. So let's look at how we are going to work this. Step one is to calculate the conversion value, right? Conversion value, which is given by PO 1 plus G raised to the power N R. What is PO? This is PO. Share price, that is 3.5 into bracket 1. This one, they say growth. If there is no growth, growth is 0. This one, they say growth is 3%. So that will be plus 0.03. Raised to the power, how many years are we looking at? They said 5 years. And the number of shares you get at conversion is 25. So that is that. So if you do your multiplication, what are you get? So 1.03 raised to the power 5 years, multiplying 3.50 and also multiplying 25 shares. That is 101. So what I have is 101.44. It's 43 something, but I keep it at 44. All right. So that is that. And I'll compare it to the redemption value. That's step 2. If they are not going to convert, what is the redemption value? Of course, like I said, unless the question tells you the thing is at discount or at premium, it is always the 100 cedis. So which one is bigger? Conversion is bigger. So it means we will set up the IRR using the conversion as our redemption value. That's all. So KDR, IRR, we have years. You have the cash flow, discount factor, PV, another discount factor, then the PV. So we have year 0, and how many years is the bond itself? Is what? 5 years. So this 5 years is different from the conversion 5 years. So don't confuse it. All right. So it means we have 1 to 5 years to be paying interest. Then we have the 5th year for redemption. So now our redemption will be the 101.44. Discount factor, like I always say, let's start with the 8%. Cash flow, the market price is how much? What is the market price? It's quoted at 82. So 82 cedis. We'll be paying interest on the coupon, which is 8% of 100. That will give us 8. 1 minus T. 1 minus T, 0.3. So T is what? 30%. So it's 0.7 multiplying 8. That is 5.6. So it means here the figure we'll be using here is 5.6. All right, that is the figure we will be using to do so because our tax is 30%, that is 0.7, and 0.7 by the interest, coupon interest, the cash flow interest, don't forget that. So we are at page 839. So we're going to take our readings and come, all right? So of course, this one is always like that. Then let's go to our reading. So we are going to read 8% for how many years? 5 years. So let's go. Annuity, this is the annuity one. 8%, 5 years. That is 3.993. Discount factor, 5th year. Let's go to discount factor, 8%, 5th year. That is 0.861. That is that. So if I am you, probably depending on the answer I'll get here. So here is 82. So 5.6 multiplying 3.993 is 22.36. 22.36. Then 101.44 multiplying 0.681 gives me 69.08. So total, so plus 22.86. Is it 86 or 36? 36. minus 82, and that gives me 9.44. All right, so that is what it gives me. Now, I'm going to push forward, and so let's use like 10%. So 10%, 5 years. Already, we know 10% 50 year is 0.621. 10% 5 years annuity. 10% 5 years, that's 3.791. So it means my 5.6 will be multiplied by 3.791, and that is 21.22 or 23 rounded. 1.00 is minus 82, and 101.44 multiplying 0.621 is 62.99. So 62.99. If I now add it to 21.23 minus the 82, I'm having 2.22. It didn't give me negative. It still gave me positive, which means I didn't push further. All right, but it doesn't matter. We still have to calculate our IRR. So KD convertible is my first percentage, which is 0.08, plus NPV of that, which is 9.44. So I have 9.44 minus 2.22 into bracket 0.1 minus 0.08. All right, so that is that. So already I have 9.44 minus 2.22. All right, so then I have 9.44 divided by that plus 0.08, right? So I have to do the multiplication on this side first, because it's multiplication. Let me check the first one that we did. Probably we forgot that, or we did that correctly. I guess we did that correctly. So you got to find out. All right, so you multiply first. All right, it's multiplication first. Board mass, don't forget. Board mass. What something we learned is where? Is it like primary school? Yeah, primary school. So this is board mass. So basically it says that you do the bracket first, all right? Divisions, all right, multiplications. So multiplications come before addition, then before subtraction. All right, so that is that. So here I had, so it was 9.44 minus 2.22. Then you are doing 9.44 divided by that, all right? And you are multiplying it by the one in the bracket. So that is like 0.02, right? Multiply by 0.02. That's the one will give you one. That's the difference. So you get that, then you add plus 0.08 to 8. All right. So that gives me 0.1061, and rounding it, I have like, it's like 10.6, which is 11% rounded. All right. So let's go and check up on this one to see if we did the correct thing. Board mass concept. So this one was 10.05 minus, that made it a plus 12.81. Then we did 10.05 divided by that. Then you have to multiply it by 0.05. 0.05. So we had, yeah, so it was correct, 3%. All right, so that is what you do. All right, board mass concept. All right. So that is what you do now. Where were we in our page? I think we were at page 389, sorry. So that is how you do your convertibles. In this one, the rate that we used was 8 and 11%. So they got the, if you still round this, I think you are close. All right. So that is how you do the conversion. First, find the conversion and use the conversion value and the redemption value, whichever is higher, just to replace this part, but you are still doing IRR. All right. So take note of that. All right. Then what do we go on to do? So we've done the cost of debt, irredeemable, cost of debt, redeemable, conversion. Let's go to 4, which is the short-term tradable debt. Short-term tradable debt. So short-term debt. Now, all these cost of debt that we are doing, it is also called yield. So if a question asks you to calculate the yield, you are basically doing your cost of debt and your IRR, all those things. They are called yield, all right? So that is that. Take note of that. Don't be moved by anything. Take note of that. All right. So now let's look at cost of short-term debt. Short-term debts are tradable. So there is no fear. What you are doing is that your cost of debt will be given by your coupon interest. Of course, all the interest is coupon. So let's go straight. Is cost of debt short-term tradable will be given by your interest. Don't forget your interest is always what? Coupon into bracket what? 1 minus T. All right. So that is that. So you do that, you are gone. That is that. So everything must be post-tax. There's no market value in this. It's straightforward because that is that. It's straightforward. Bank loan, we were looking at. So tradable is the one that we did. Sorry, let me correct that. Tradable is the redemption one and all those things. So here we are actually looking at a bank loan, which is non-tradable. If you take a bank loan, if you take a bank loan, you don't sell it. It's a bank loan. You took it, you pay it. All right. So I say it is short term, but non-tradable. So that is what we are saying. Short term, non-tradable. You can't sell it. So there will be no market value. Actually, your market value is your book value. Take note of that. So your market value is just the book value. So here you just multiply short term. All right. So that is 4, right? Okay. So let me check on how I introduced it to you. Go back and so that you can have the right notes. All right. So here we call it short-term non-tradable. Short-term non-tradable or bank loans. All right. Bank loans. If you take a bank loan, you can't say you are selling the bank loan. Somebody should go and pay the money. No, you pay the money to the bank. The same person who did that. All right. So that is that. Okay. So basically that is it. But here the only danger is what you should learn in addition, which we call credit risk. Credit risk. All right. Or the spread. You need to understand that is the only thing probably they may add as confusion. Now, watch this. The credit risk is kind of you see the bank loan and some of these things you have to understand that credit ratings affect it. All right. So here I give an alternative techniques. We use that one in advanced financial management when deriving the cost of debt that is based on credit risk. So sometimes you may have credit risk, also referred to as the default risk. All right. Default risk is the same thing. All right. Default risk is the same thing. Default risk is the same thing. Now you will continue to do what you are doing, like the cost of debt. Of course, everything is post-tax. All right. So we are doing everything post-tax. So you do the cost of debt. All right. NT. So should I call it short-term or NT? You can just designate it anyhow you want. It's just terminology. So, all right. So whatever that you want to call it, you will bring the risk-free rate plus the credit spread or the premium default risk. Default risk. All right. Default risk. So that is what you do. Just a minute, guys. All right. So basically, that is how the a short-term non-tradable bank loan. Okay, so we can even call it bank loan. All right, so that is that. That is how it is. So your I will now be the risk-free, because the interest, this one is here, is the combination of your risk-free rate of return, which is the interest, plus a default risk. All right, so that is that. Then you still bring your 1 minus T. All right, so basically that is how you calculate your cost of bank loan or non-tradable debt. All right, so that is that. Then the last one is cost of preferences. I mean, that one is very easy. All right, so this is it. I mean, it's dividend. So cost of preference share, KP, will be given by the dividend. All right, then the market value. All right, of shares, X div. All right, so basically that is that. So you put all together, then you calculate your WACC. All right, so today we've looked at how to calculate the various cost of debts. So in the next lecture, what we'll be doing is to put them together to compute a WACC. All right, so we will look at the WACC format or the formula in broad perspective, pick up a question and calculate our WACC. Then the last video, we'll be looking at the optimal capital structure. All right, which one is the best for us to use? Do we use all equity? Should we use all debt? Should we do a mixture of the debt? What is the impact? Because debt, when you use debt, what is the meaning? What is the effect? When you use equity, what's the meaning? I'm going to take my time to explain all those things to you. So stay tuned for part 3 of the WACC video, where we now consummate everything that we have done from the equity perspective and from the debt perspective. Don't forget to share the video. And always, when you finish watching the video, please, I honestly ask or humbly ask that you will share a comment. All right, so type a comment if it feels good. Type a comment. All right, so that is that. God bless you, and see you in part 3.